Hi there. The today topics is about the basic understanding on asset and the ownership to experience. So asset consists of the two parts, current asset and non-current asset. So current asset means you can convert to the cash within the 1 year. For example, cash and the cash equivalent, account receivable, and inventory. This is a current asset. So, and the non-current asset, so basically the companies use the non-current asset more than 1 year. This is a non-current asset. So in other words, you can take fixed asset instead of the non-current asset. And non-current assets consist of the three parts again. The first one is tangible asset and intangible asset. And the last one is investment and other assets. So now look at the tangible and intangible asset. So tangible means visible, touchable. You are able to see the fixed asset. So this is intangible. Okay. Intangible is that you cannot see. So here's the example of the tangible asset, like a building, structure, vehicle, truck, land, machinery, office equipment, and so on. This is the tangible asset. Next one is intangible asset, software, goodwill, patents, copyright. So let me focus on the land. Okay, land, you cannot depreciate that land. So, but depreciation is a new terminology, I think so. So, at the end of this presentation, you can understand the depreciations. Don't worry. So, asset transactions. So to make it simple today, the actual scenario is very complicated, but today let me make it simple to explain about asset transaction. The first one is acquisitions. So you purchase or you acquire the fixed asset. This is the first step. The second step is the depreciation. And the last step is the disposal or sales of the fixed asset. So, for example, you cannot use the fixed asset anymore. You will not use anymore. So that's why disposal, throw away, or you can sell it to the customers, something like this. The acquisitions. What is the journal entries of the acquisitions? Journal entry we review. We checked the journal entry in the last video. So if you want to understand, if you don't see the not yet, so please check that video. Okay. So the journal entry of the acquisitions, debit side is equipment, $15,000 US, for example, in this case, and the credit side is cash or account payable, $15,000 USD. Okay. So journal entry for the depreciations, let's take a look at in the following slides. Okay. So the depreciation also one of the calculations. Okay. So the basically 4 parameters to calculate the depreciations. This is for the basic parameters. Yes. The first one is acquisition cost. In other words, original cost. B, depreciation method. C, useful life. And D, residual cost. In detail, let's check the one by one. The first one is acquisition cost. This is very, very simple. So here, $15,000 Okay, acquisition cost. Next one is the depreciation method. Depreciation method means how to depreciate the fixed asset, the amount. So many types of the depreciation method, but the most simple, the easiest one is a straight line. Okay, in the next slide, I will explain the straight line. Okay, and next one is a useful life. Well, useful life means that over the specific period, so we need to depreciate the fixed asset value. So because when you acquire the fixed asset, this is very new one, the fresh one. But over the specific period, this value of the fixed asset is going down. Okay, so we need to recognize the depreciation expense as per the accounting principle. Okay, and the useful life. Okay, so in this case 50 years. Okay, 5 years, sorry, 5 years. 5 years means 16 months. 60 months, 60 months. Okay. The last one is a residual cost. In other words, salvage value. Okay, here is the example. This is just example. 10%. Okay, 10% of acquisition cost. Okay, acquisition cost is 15,000. So that's why this case 1,500. Okay, 1,500 is the residual cost. Okay, so the residual cost, so you cannot depreciate. Okay, okay, let's calculate. Let's exercise. Okay, the first step. Okay, let's calculate the depreciation expense based on the straight line method. The first step is acquisition cost 15,000. Okay, minus residual cost 10%. Okay, 1,500. So this amount can be depreciated over the useful life 60 months. Okay, as a result, you can get the $225 as a depreciation. I think this is very easy. Okay, you can understand the depreciations. So let's check the journal entries. Of course, the financial account always starts with the journal entries. Okay, and then the last step is making the financial statement. Okay, so the depreciation transaction for the journal entries is like this: debit depreciation expense $225, and the credit side is accumulated depreciation. Accumulated depreciation, new chart of account for you, but the accumulated depreciation is the one of the BS account. Okay, so the 225. Okay, and here's the equipment and accumulated depreciations. The both of them is the asset account, fixed asset account. Okay, so now how can we show the fixed asset in the balance sheet? Okay, 3 months later. Okay, 3 months later after acquisitions. Okay, 225. Okay, this is a monthly depreciation amount. So 225 multiple 3 months. Okay, like this. So this part, non-current asset part. Okay, please focus on the non-current asset part. Okay, and non-current asset part, of course, the tangible part and intangible part and investment part. Okay, so okay, and equipment 15,000 you acquire, right? And then the next line, accumulated depreciation for the equipment. So 3 months, 225 multiple 3 months. This means 675. So 675s need to be deducted from the 15,000. Okay, equipment. So as a result, 14325. Okay, 14325 is the end of the equipment after the 3 months. This amount. Okay, so accumulated means just plus and plus and plus. So 225 plus 225 plus 225. So accumulated means sum up over the specific period. Okay. Sometimes accumulated is often used for the accountings. Okay, the sessions. Here the next lesson topics: inventory, tax, or managerial account consolidations. So I will cover the topics the following lessons. Thank you for watching our video today as well. Please subscribe to our channel. Thank you very much.